We checked, we had mixed markets to start the session. That's still the case, but the Dow is actually just flat here. The S&P 500 pointing down about 0.2%. We have the NASDAQ pointing down almost 0.4%. Now on that, I want to bring in Shana Sissel, CEO of Banríon Capital Management. Shana, welcome to the show. Thanks for joining us. What's your reaction so far to how the markets are opening?
Not incredibly surprised. We've digested some of the banking issues, so the markets have sort of stabilized. But I still think that there's downside to come as we continue to see pressure from monetary policy, as well as just the companies and the banking system correcting itself. So I think there's still some downside to come, and a recession is very probable.
Speaking of monetary policy, we obviously had the Fed last week hiking interest rates by an additional 25 basis points, that being the 9th consecutive hike since March of last year. How should investors be prepared to weather this? What should they be taking away from this as we move ahead?
What they should be taking away from this is that the Fed is very serious about bringing inflation down to its 2% target. We're at around 6%, so we still have a very long way to go. There's a lot of investor sentiment suggesting that the Fed may cut in 2023. I think that that is a pipe dream. I don't think there's any chance that the Fed is going to cut rates this year. So investors should be positioning themselves for continued volatility in the market, definitely continued downside, and some rough economic goings in the next 6 to 12 months.
Now, we've heard some mixed commentary from major officials, Treasury Secretary Janet Yellen coming out and suggesting that she would support banks. We know these prepared remarks from Fed Governor Michael Barr later on today, suggesting that this bank crisis does require a risk assessment on how to prevent, mismanagement at one bank from infecting the rest of the sector. What's kind of your takeaway to what you've heard so far from regulators concerning this issue? Should investors at this point be worried about other banks collapsing or this contagion spreading any further than it already has?
Well, I think the comments about mismanagement at SVB are a bit disingenuous. I'm not suggesting that SVB did everything right, but this was an asset liability mismatch that was brought on by a rapid rise in rates, which is highly unusual. These banks were not investing in risky assets. They were investing in treasuries, and they were simply on the wrong side of duration. And that was a major problem when it comes to mark-to-market security pricing. So what we saw with SVB was that that was a signal that other banks probably had the same problem, and people started to look for that. It is somewhat mismanagement, but you have to also take into consideration that the banks have had to adjust their policy and how they invest their assets if they're not getting the opportunity to lend money over time. And it's not completely outlandish for them to use treasuries as the way to manage those assets. The problem was the rapid rise in rates over a very short period of time. So the banking system is actually quite strong, and this is not an indication of a solvency problem. It's an indication of a liquidity problem in which the Fed and the powers that be that oversee the banking system do have the ability to sort of resolve, of which they've done. So I think we should feel secure that the steps have been taken for banks to address the liquidity problem. And I don't think that there's a long-term concern about a massive run of bank failures at this time. So, in my opinion, it's really a little bit of a couple of things, but I do think it's disingenuous to say this was massive mismanagement on the part of SVB.
Absolutely. And of course, another story that we've been following is Credit Suisse, that saga with the forced acquisition by UBS. Now UBS coming out and saying that they didn't acquire the bank only to close it. Obviously a lot of headlines coming from the banking sector all at the same time. We know these issues aren't necessarily related. But what's your take on UBS and Credit Suisse, and how does that reflect on bigger banks and how they are being run, particularly as it pertains to risk management at this time?
Well, Credit Suisse is a bank that has had known issues for quite some time. Deutsche Bank also falls into this bucket. I think with the increased scrutiny on banks after the SVB collapse, just made it more obvious that these problems that both Credit Suisse and Deutsche Bank had had for some time were something that needed to be addressed and addressed now so that they didn't become part of the contagion. Because what was happening was people were looking for the next bank failure, and they were absolutely focusing in on the banks that had known problems, and Credit Suisse was one of them. I don't think that we have to worry about Credit Suisse ceasing to exist. UBS is a nice, strong bank. Deutsche Bank is another bank that, yes, it has problems, but I don't think we have to worry about it ceasing to exist. After the financial crisis, a lot of safeguards were put in to make it so these very large banks were too big to fail, and it was a global initiative. So I do not think that we need to panic or worry. I think that any bank that has been identified as having issues is being addressed in real time. And I do not think that there's going to be some major contagion where we see these massive banks dropping like flies.
Yeah, Shana. So speaking of, let's talk about economic data quickly here. So we have personal consumption expenditures expected to come out on Friday. This is one of the Fed's preferred measures of inflation. Based on all the indicators that we've seen in this last 25 basis point rate hike, what are you expecting to see? Do you expect to see signs of inflation continuing to cool, and how might that affect monetary policy moving ahead?
Well, I think that there is a chance that we'll see signs that inflation is starting and continuing to cool, but it's a very slow process. When you look at those inflation measures, they're kind of real-time measures of like prices today, whereas the Fed's policy and their rising of rates, it takes time. And a lot of what they look at is lagging. And this, in some way, is a bit lagging because we're looking at last month's data. So I actually don't expect us to see overly cooling, but hopefully continuing the trend. The problem is it's not cooling quick enough. And this is a problem when you think about what the Fed's trying to deal with. They're trying to avoid economic problems, but at the same time, they are really fixated on that 2% number. The good news is that the employment markets seem pretty stable, and that should make it easier for the Fed to make policy.
We have to leave it there, but thank you so much, Shana Sissel, CEO of Banríon Capital Management. We got more Cheddar next.